8 months post-incorporation period. Therefore, the time ratio is 4:8, 1:2. First pre-incorporation 5 lakh, the balance is 15 lakh, the difference is 5. So ratio is 5 lakh is to 15 lakh is 1:3. Discount received on purchase ratio 1:3, totally 4,000. 1,000 goes to pre-incorporation, 3,000 goes to post-incorporation. Hello my dear students, I am Dr. B.S. Subramaniam, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College at Temple of Excellence, Mysuru. I am going to have Corporate Accounting 1, third semester Unit 2, Session 4 in favor of profit prior to incorporation. I told in the last session, whatever the profit earned before incorporation is called pre-incorporation profit. Whatever the profit earned after incorporation is called post-incorporation profit. I will repeat this word. Whatever the profit earned before registration, before incorporation is called pre-incorporation profit. Whatever the profit earned after incorporation at the end of the year is called post-incorporation period. So, in pre-incorporation period, there are two ratios. One is called the time ratio and is called the sales ratio. Which are the two ratios are? Major is one is called time ratio, another is called the sales ratio. One is time of registration, second depends upon the sale. So we move on to problem now. Sanatana Limited acquired a running business from Sanmarga on 1st January 2020, which was incorporated on 1st May. So January, February, March, April. January, February, March, April, May. 1st May means first 4 months. Then the combined profit loss account of the company prior to him. So they asked to prepare pre-incorporation and post-incorporation. Now this is all the salary goes to time ratio, general expense goes to time ratio, discount allowed based on sales ratio, selling and distribution expense based on sale ratio, preliminary expenses post, audit fees time ratio, director fees post, rent paid based on time ratio, interest on debenture post, depreciation time ratio, gross profit based on sales ratio, discount received based on purchase ratio. Here, sales up to 30th April were rupees 5 lakh out of sales of 20 lakh. Totally, sale is 20 lakh up to 30th April, 1st May. January, February, March, in first 4 months. Date of purchase 1/5/2020. From 1/1/2020 to 1/5/2020 is 4 months. This is a pre-incorporation period. From 1/5/2020 to 31st December 2020 is called 8 months post-incorporation period. Therefore, the time ratio is 4:8, 1:2. One is pre-incorporation, another is post-incorporation. Come back to sales ratio. See that? Sales before is 5 lakh, at the end of is 20 lakh. Sales. First pre-incorporation 5 lakh, the balance is 15 lakh, the difference is 5. So ratio is 5 lakh is to 15 lakh is 1:3. Then profit. Discount received is called on the purchase ratio. Pre-incorporation purchase is 3 lakh, post-incorporation is 9 lakh. You see that purchase, pre-incorporation 3 lakh, post-incorporation 12 lakh means become 9 lakh. Pre-incorporation period 3 lakh, post-incorporation period is 9 lakh, 3 lakh is to 9 lakh, 1:3. Repeat once again. It was purchased on 1st January. So 1st May, next 30th April. January, February, March, April. First 4 months is pre-incorporation. Next 8 months is post-incorporation period. That is the time ratio. Date of purchase 1/5/2020. From 1/1/2020 to 1/5/20 is 4 months pre-incorporation. from 1/5/2020 to 31st December 2020 is post-incorporation 8 months. This is 4 months. Time ratio is 4:8 is 1:2. Come back to sales. First pre-incorporation 5 lakh out of 20 lakh is 15 lakh. So sales ratio pre-incorporation period is 5 lakh. Post-incorporation period is 15 lakh. Sales ratio is 5 lakh to 15 lakh. They are in the ratio of 1:3. Then come back to purchases 3 lakh. Out of 12 lakh is balance is 9 lakh now. Pre-incorporation period 3 lakh. Post-incorporation period 9 lakh. So they are in the ratio 3 lakh is to 9 lakh, 1:3. So this is for discount received. Gross profit 1,50,000 based on sales ratio, that is 1:3. 1/4 is 37,500. Then 3/4 is 1,12,500. Discount received on purchase ratio 1:3, totally 4,000. 1,000 goes to pre-incorporation, 3,000 goes to post-incorporation. So total revenue so 1,54,000 total. Then 38,500 is the pre-incorporation profit. 1,15,500 is the post-incorporation profit. Then less expenses. What are the expenses? Salaries based on time ratio 1:2. What is the total amount? 30,000. 10,000 to pre-incorporation, 20,000 to post-incorporation. General expense based on time ratio 15,000. 5,000 goes to pre-incorporation, 10,000 goes to post-incorporation. Discount allowed based on sales ratio 1:3. The total amount is 10,000. 2,500 goes to pre-incorporation. 7,500 goes to post-incorporation. Selling and distribution based on sales ratio 1:3. 2,800. 700 goes to pre-incorporation. 2,100 goes to post-incorporation. Primary expenses direct, connected. Then audit fees based on time ratio 1:2. 1,500, 500, 1,000. Director fees direct 2,300, 2,000. Then rent paid based on time ratio 1:2. 12,000, 4,000, 8,000. Interest on debenture direct 2,500, 2,500. Depreciation based on time ratio 1:2. 4,500, 1,500, 3,000. If we add all these expenditure, it will come 85,600. Then your total 1,54,000 minus 85 means 68,400. Then pre-incorporation 38,500 minus 24 piece 14,000. Whatever the profit earned in the pre-incorporation we called as capital profit. Then whatever the profit comes under revenue profit, post-incorporation is called, this is called revenue profit, this is called capital profit. I have given note also. Capital profit transfer to capital reserve account, whereas revenue profit transfer to statement of profit and loss account. It can be utilized for distribution of dividend. Capital profit should not be utilized for distribution of dividend, whereas revenue profit transfer to profit which can be utilized for distribution of dividend. I think this is very easy, but you have to calculate slowly the time ratio, slowly the sales ratio, the most important. So what are the things most important? Whatever the profit earned before incorporation is called pre-incorporation profit. Whatever the profit incurred after incorporation is called post-incorporation period. That's only a time ratio. Before incorporation and after incorporation based on the time. Then whatever the sales take before incorporation, pre-incorporation sale, whatever incurred after post-incorporation sale. This is most important. Discount received only on purchases ratio. Okay. So you have to calculate one time ratio, second one sales ratio. If any discount received, you have to calculate the what's called the purchase ratio also. Which are the three important ratios are one is time ratio, date of purchase, date of incorporation, from incorporation year ending. Then there's a time ratio, sales take place before incorporation, sales after incorporation, sales ratio, discount received based on purchase ratio. Hope you understand. Very, very easy problem they will ask. Hope you understand. You take the time ratio, distribute amount pre-incorporation, post-incorporation, pre-incorporation, profit. Whatever the profit earned in the pre-incorporation profit is called capital profit, which cannot be utilized for dividend. It will be transferred to capital reserve. Whatever the profit earned in the post incorporation is called revenue profit. It can be utilized for distribution of dividend among the shareholder. Hope you understand. We'll meet in the next session with another problem. Till then, goodbye. Meet in the next session.